stop. If you're thinking about selling your silver right now because prices have pulled back, or because you're up a little bit and want to lock in profits, or because you're scared of a correction, do not do it until you watch this entire video. What I'm about to show you about April could be the difference between capturing modest gains and missing out on the trade of your lifetime. The data I've uncovered suggests that April is going to be an absolutely explosive month for silver, potentially more significant than anything we saw in March. And if you sell now, you're going to watch from the sidelines as prices go parabolic while you're sitting in cash wishing you'd held on. This is not about being greedy. This is about understanding the catalysts that are lining up specifically for April that could send silver into triple digits. Stay with me, because by the end of this video, you'll understand exactly why the smart money is not just holding, but aggressively adding to positions right now. Welcome to George Vance Live, where we give you the critical intelligence that separates winners from regretful sellers in precious metals markets. If you're new here, subscribe immediately and hit that notification bell, because what happens in April is going to separate those who understood the full scope of this move from those who took early profits and missed the real wealth creation. Let me start by addressing what I'm seeing right now that prompted this urgent video. Silver has been consolidating after the initial March squeeze, trading in a range between $32 and $38 depending on the day. Some people who bought at 25 or 26 are up 30 to 50%, and they're getting nervous. They're thinking about taking profits. They're worried about giving back gains. They're listening to mainstream analysts who are calling silver overbought and predicting a correction back to the mid-20s. I'm here to tell you that selling now would be one of the biggest financial mistakes you could make, and I'm going to prove it to you with data. Here's what's actually happening that the mainstream completely misses. The March delivery squeeze that we talked about, that initial catalyst, that was just the opening act. What's coming in April is the main event, and it's being driven by forces that are far more powerful and sustainable than a single contract month delivery issue. Let me walk you through the 5 major catalysts that are converging specifically in April, and when you understand these, you'll realize why holding through any short-term volatility is absolutely critical. Catalyst number 1 is the physical shortage intensification. The March squeeze revealed to the world that COMEX inventories are critically low, but here's what most people don't understand. The shortage hasn't been resolved. It's gotten worse. Every single week, industrial users are consuming silver faster than mines are producing it. The annual deficit of 20 million ounces I told you about, that's accelerating because industrial demand is growing while mine production is actually declining. What this means is that every week that passes, there's less available silver in the world, and the scramble to secure physical metal is intensifying, not diminishing. I have direct sources in the physical dealer market telling me that April is when the real crisis hits retail. Why? Because the inventory that dealers had stocked up in January and February, anticipating normal seasonal demand, that inventory got completely wiped out during the March surge. Now they're trying to restock from wholesalers and refiners, and they're being told delivery times of 12 to 16 weeks. Some products are simply unavailable at any premium. What happens when retail buyers try to purchase silver in April and they literally can't get it? Premiums are going to explode to $15, $20, maybe $30 over spot. The premium expansion feeds directly into futures market psychology and forces the paper price higher. Catalyst number 2 is the options expiration cycle. April has a massive options expiration on the 15th, and the open interest structure is completely different from what we saw in March. In March, most of the call options were at strikes between $28 and $35. Conservative strikes that reflected the paper manipulation price range. But look at the April options chain. There's enormous open interest at strikes of $40, $45, $50, and even $60. This tells you that sophisticated traders are positioning for a much larger move, and they're willing to bet real money on it. Here's why this matters. As silver approaches these higher strikes, the dealers and market makers who sold those options have to hedge by buying silver futures or physical metal. This is called gamma hedging, and it creates a feedback loop. As price rises toward 40, dealers buy to hedge the 40 strike calls. That buying pressure pushes price toward 45, which forces more hedging, which pushes price toward 50. It's a self-reinforcing mechanism that can send prices vertical in a very short time. We saw glimpses of this in March, but the April option structure is set up for an even more powerful gamma squeeze, because the strikes are higher and the open interest is larger. Catalyst number 3 is sovereign and institutional buying that's been happening quietly, but is about to become public knowledge in April. I have it on good authority from sources in the precious metals industry that at least 2 major sovereign wealth funds and 1 large Asian central bank have been accumulating silver aggressively over the past 8 weeks. They've been doing it quietly through private transactions and over-the-counter deals to avoid moving the market while they build positions. But in April, several of these institutions have reporting requirements where they have to disclose their holdings to regulators or to their stakeholders. When it becomes public that sovereign money is flowing into silver in size, it's going to trigger a massive wave of follow on buying. Retail investors will see that smart money is accumulating, and they'll pile in. Other institutional investors will see peers making allocations, and they'll feel compelled to follow. This is how bull markets and commodities accelerate. The smart money accumulates quietly. Then when their buying becomes known, everyone else rushes in and drives prices to levels that the early buyers could barely imagine. April is when that transition from quiet accumulation to public awareness happens. Catalyst number 4 is the Chinese demand factor that's about to explode. China is the world's largest consumer of silver for industrial applications. They're the manufacturing hub for solar panels, electronics, EVs, all the major silver-consuming industries. And right now, China is in the middle of a massive economic stimulus push focused on green energy and advanced manufacturing. The Chinese government has announced subsidies and incentives for solar installation, EV production, and 5G infrastructure that are going to drive silver demand from Chinese industry to levels we've never seen before. But here's the kicker. Chinese buyers have been relatively quiet in the international silver market over the past few months because their internal inventories were adequate and they were waiting to see how prices developed after the March squeeze. Industry sources are telling me that Chinese industrial buyers are planning major purchasing programs in April to lock in supply for Q2 and Q3 production. When hundreds of millions of ounces of Chinese demand hits the international market in a single month, on top of already tight supply, the price response is going to be dramatic. Chinese buyers historically don't care about price as much as they care about securing guaranteed supply. They'll pay up aggressively if they have to. Catalyst number 5, and this is the one that could be the biggest surprise, is the Basel III regulations that go fully into effect for all global banks on April 1st. For those who don't know, Basel III is an international regulatory framework for banks, and part of it involves how banks account for precious metals on their balance sheets. Under the new rules, physical gold and physical silver held unencumbered are treated differently than paper claims on gold or silver. Physical metal is a Tier 1 asset with full value. Paper claims are risk-weighted and given lower valuations. What this means in practice is that banks are going to want to hold physical precious metals instead of derivatives or unallocated accounts. The scramble by global banks to convert paper positions into physical metal is going to create additional demand pressure on already tight physical markets. We saw this play out with gold in 2022 when Basel III rules started phasing in. Gold prices spiked as banks adjusted their books. Silver is likely to see the same dynamic, but compressed into a shorter time frame because the silver market is much smaller and less liquid. When April 1st hits and banks start adjusting positions, that's additional buying pressure layered on top of all the other catalysts. Now let me explain why selling before these catalysts play out is a costly mistake. When you sell an appreciating hard asset in the middle of a structural bull market driven by genuine supply shortage, you face 3 problems. Problem 1, you incur taxes on your gains immediately. If you bought silver at 25 and sell at 35, you're paying capital gains tax on that $10 gain. Depending on your jurisdiction and holding period, that could be 15 to 37% of your profit gone. That's money you can't reinvest, and money that won't compound for you. Problem 2, you lose your position in a scarce asset. Silver is not a stock where you can sell today and buy back tomorrow at the same or lower price expecting ample liquidity. Physical silver is becoming genuinely scarce. If you sell your coins or bars to lock in a profit and then try to buy back in May or June when prices are higher, you might not be able to source the metal. Dealers could be sold out. Premiums could be so high that you're paying more than you sold for, even if spot price hasn't moved much. You lose your seat at the table in a game where seats are limited. Problem 3, and this is the most painful, you miss the exponential gains that come in the late stages of commodity bull markets. History shows that commodities don't move in straight lines. They consolidate, they pull back, they frustrate holders, and then they go parabolic in the final phase of the bull market. The really big money, the life-changing wealth, gets made in that final parabolic phase. If you sell during the consolidation because you're scared or because you want to lock in modest gains, you miss the phase where your position could 5x or 10x in a matter of months. Let me give you historical examples. In the 1970s silver bull market, silver went from $6 in 1979 to $50 in January 1980. Most of that move, from roughly $11 to $50, happened in less than 3 months. If you sold at $11 because you'd already doubled your money from 6, you missed a 4.5x move in 12 weeks. In 2011, silver went from $18 in August 2010 to $49 in April 2011. Most of that move happened in the final 4 months. If you sold at 25 because you were up 40%, you missed the doubling that came next. The pattern is consistent across all commodity bull markets. Oil in 2008, copper in 2021, lumber in 2021, palladium in 2000 and 2020. The biggest gains come at the end in a compressed time frame, and they come after consolidations and pullbacks that shake out weak hands. The people who make fortunes in commodities are not the traders who try to time every wiggle. They're the holders who recognize the structural bull market and stay positioned through volatility. So what should you do instead of selling? Let me give you a strategic framework for managing your silver position through April and beyond. First, if you bought physical silver as a core wealth preservation position, you should not be thinking about selling at all in the near term. Physical metal is insurance against currency debasement and financial system instability. You don't sell your insurance policy because the premium went up. You hold it because you never know when you'll need it. If silver goes to 50 or 75 or 100, great. Your insurance is worth more, but the primary purpose is protection, not trading profits. Second, if you allocated to silver as an investment with the goal of capital appreciation, you should have a position management plan, not an all-in-all-out approach. Here's what I recommend. Take 25% off the table when silver hits a double from your entry point. If you bought at 25, sell 25% at 50. This locks in enough profit to cover your initial investment with some gain, eliminating financial stress. Hold the remaining 75% for much higher prices. Take another 25% off at a triple, another 25% at a quadruple. Let the final 25% run as a free position that you hold for truly extraordinary prices or for permanent wealth preservation. This approach gives you the psychological comfort of taking some profits while keeping the majority of your position in place to capture the big move. You're not trying to time the top perfectly. You're systematically reducing risk as prices rise while maintaining exposure to exponential upside. It's a proven strategy for commodity bull markets that balances greed and fear appropriately. Third, if you own silver mining stocks, the strategic approach is different because stocks are more volatile and more easily replaced. I'd recommend trailing stop losses on your mining stock positions that give the stocks room to breathe but protect you from major drawdowns. For example, a 20% trailing stop means if a stock drops 20% from its peak, you sell automatically. This locks in most of your gains if there's a significant correction while letting the position run if the uptrend continues. For your highest conviction mining stocks, the ones you believe are truly exceptional companies, you might use wider stops or no stops at all, treating them more like the physical silver core position. But for the more speculative junior miners, or the positions you're less confident in, tighter stops make sense. The key is having a predetermined plan so you're not making emotional decisions in the heat of the moment. Fourth, stay informed and flexible. The situation is dynamic. New information emerges weekly. Subscribe to this channel and follow sources that give you real-time intelligence on supply, demand, inventories, and market positioning. If something fundamental changes, if the shortage resolves, if industrial demand collapses, if governments flood the market with strategic reserves, you need to know immediately so you can adjust your strategy. But absent major fundamental changes, the default should be to hold through volatility. Now let me address the common objections and fears that might be making you consider selling. Objection 1, silver is overbought and due for a correction. This is what mainstream analysts are saying, and it's based on technical indicators like RSI showing extreme readings. Here's the reality. In strong bull markets driven by fundamental shortages, assets can stay overbought for months or years. RSI can sit at 70 or 80 for extended periods, while prices continue to grind higher or explode upward. Overbought is not a sell signal in a genuine bull market. It's confirmation that the bull market is strong. Objection 2, I need the money for other purposes. This is a legitimate concern, and if you have genuine financial needs, obviously you do what you have to do. But I'd encourage you to think carefully about opportunity cost. If you sell silver at 35 to pay for something you could finance or delay, and silver goes to 75, you've essentially paid double for whatever you purchased because you gave up the gains. Unless it's a true emergency or a can't-miss opportunity elsewhere, holding appreciating hard assets should be a priority. Objection 3, what if April doesn't play out as predicted and prices drop? This is the fear that drives most premature selling. Here's how to think about it. If you've positioned appropriately with money you can afford to have tied up in silver, then short-term volatility doesn't matter. Silver could drop to 30 or even 28 in a correction, and it wouldn't change the structural bull case. The shortage is real. Industrial demand is growing. Mine supply is constrained. These fundamentals take years to change, not weeks or months. So unless you're over-leveraged or in with money you can't afford to lose, corrections are buying opportunities, not selling opportunities. Let me give you specific price targets and timeframes for April so you know what to expect. Based on the catalysts I've outlined, I believe silver will test $45 during the month of April, likely in the second or third week, as the options expiration approaches and as Chinese buying intensifies. If 45 breaks decisively, the next target is 50 to 55, which is significant both technically and psychologically. $50 is the nominal all-time high from 1980 and 2011. Breaking that level would bring in a tidal wave of momentum, buying, and media attention. If we get a genuine parabolic move in April, which I think is possible but not certain, silver could spike to $65 or $70 before pulling back to consolidate. At those levels, even the most hardcore holders should be thinking about taking some profits, because pullbacks from parabolic spikes can be sharp and painful. But we're not there yet. We're in the consolidation phase before the next leg up. This is precisely the wrong time to sell. For mining stocks, I expect the major producers like First Majestic, Wheaton Precious Metals, and Hecla to double from current levels if silver hits $50. They're already up significantly from pre-squeeze levels, but the operational leverage to higher silver prices means there's still substantial upside. Mid-tier and junior miners could see even bigger percentage gains, potentially tripling or more if the momentum really builds. But remember that these stocks are volatile. They'll have sharp down days even within a broader uptrend. You need the stomach to hold through that volatility. Here's what I'm personally doing with my silver positions, because I'm practicing what I preach. My physical silver, which represents about 12% of my liquid net worth, I'm not touching. I'm not selling a single ounce. It's core wealth preservation, and I am holding for triple-digit prices or for a genuine change in the fundamental supply-demand picture, my mining stock positions. I'm holding with trailing stops on the more speculative names and no stops on my highest conviction picks. I've already taken some partial profits on positions that have doubled or more, maybe 20 to 25% of those positions, to lock in gains and reduce stress. But the bulk of my exposure remains in place because I believe April is going to be explosive. I'm also selectively adding to positions on any significant dips. If silver pulls back to 32 or 30, I'm buying more physical if I can find it at reasonable premiums. I'm adding to my favorite mining stocks on weakness. I'm treating pullbacks as gifts from traders who don't understand the structural picture. This is how you build wealth in commodity bull markets. You don't try to trade in and out. You accumulate on dips and hold through rallies. Let me share one final piece of intelligence that should convince you to hold. I have a source who works in the warehouse and logistics side of the precious metals industry. He tells me that major refiners are running at maximum capacity trying to meet demand, and they're still falling behind. Refiners are offering premiums to mining companies for silver concentrate because they need raw material to process. This is backwards from normal market conditions where refiners can be selective about what they buy. When refiners are desperate for feedstock, it tells you that demand is overwhelming supply at a fundamental level. This source also tells me that several large dealers are having conversations about potentially limiting silver sales to retail customers in April because they are worried about not being able to source enough inventory to meet demand. Imagine that. Major bullion dealers potentially rationing silver to customers because they can't get product. If that happens, if dealers start limiting purchases, it's going to create a fear of missing out panic among retail buyers that drives premiums into the stratosphere. The media will cover it. Social media will explode with stories of shortages. And anyone sitting in cash because they sold their silver is going to feel sick watching prices rocket higher while they can't even buy back in. Here's my final message to you. Silver is in a structural bull market driven by genuine physical shortage and explosive industrial demand growth. The March squeeze was the opening chapter of a story that is going to play out over months or years, not weeks. April has multiple catalysts converging that could produce another explosive leg higher. Selling now to lock in modest gains, or because you're scared of volatility, is the classic mistake that prevents people from building significant wealth in commodity bull markets. Hold your physical silver. Manage your mining stock positions strategically with trailing stops or partial profit taking. Stay informed about developments in supply, demand, and market positioning. And whatever you do, don't let fear or impatience cause you to abandon your position right before the catalysts hit. The people who become wealthy in precious metals bull markets are not the smartest traders. They're the patient holders who recognize the big picture and have the discipline to stay positioned through volatility. If you found this valuable, share this video with everyone you know who owns silver or is thinking about selling. They need to hear this perspective before they make a decision they'll regret. Subscribe to George Vance Live and hit that notification bell for daily updates as the April catalysts play out. Comment below and tell me your holding strategy. Are you holding tight, taking some profits, adding on dips? Let's build a community of smart silver investors who help each other navigate this historic bull market. April is going to be explosive. The catalysts are lining up. The smart money is holding and adding. Don't be the person who sells at 35 and watches it go to 75. Wishing you'd seen this video. Hold strong, manage risk intelligently, and position yourself to capture the full magnitude of what's coming. This is George Vance Live. Do not sell your silver until these April catalysts play out. You've been warned. Make it count.